So this is the official start. And Abri is very concerned that I'm going to take up too much time. And as usual, Abri's right. But Reuben, if I can ask you to load up the presentation. Thank you. All right. So this is going to be our official start. I'm just letting in the last people who were looking for some parking. They found parking, so everyone's here. So officially, welcome. Welcome. Thank you so much for your time. Thank you for taking the time out to meet with us. We really do appreciate it. Just the way that we've arranged this particular presentation, the content of the presentation, is just to do a quick check-in on what we spoke about the last time that we did a presentation. Very high level. What you'll realize from this is that the more things change, the more they stay the same. But that very deep, profound wisdom isn't what you pay us for. So Reuben and Abri are going to basically walk us through, take a quick check back to about a year ago, the last sort of 6 to 12 months, what we said, why we said it, and then basically starting here. What ideally I would have wanted to do is go with a whole Ramdas guru type of approach, but apparently that's not in order. Pema Chodron has written a book called Start Where You Are. So the best I can do in translating that is to say, let's start here, because that's really all we can do. So just looking at where we are right now, just a couple of pointers that we need to remember, and you'll see this is a quick recap, and you'll know it's a quick recap because there's a little sign on the slide that says quick recap. When that sign's not there, we're no longer recapping, we are present. All right, so let's do this. Don't you love when there are instructions? I love when there are instructions, all right. So just the points that we do need you to bear in mind. First and foremost, nothing exists in isolation. We know this. Everything's interconnected, and the knock-on may not be felt immediately, but in due time it will become apparent. What's very important for us is not to present ourselves as being right. More importantly, not to be wrong. But it's not about that, because even a broken clock is right twice a day, and there will be a time that everything has its moment. So it's more about what our commitment is, and our commitment is to protect and grow investors' wealth. And the way that we do that best is to take into account the two factors that destroy wealth, being costs and emotion. So that's what we need to maintain. Quick overview on our asset allocation philosophy, and I include this simply because we do it so differently. We know that asset allocation adds way more value than stock selection. It needs to be meaningful. It can't be a meh kind of thing, an anemic type of implementation. Make it real or really don't bother. We look to avoid primary down cycles. We look in that situation to preserve capital. And our endeavor is constantly to find the best risk-adjusted return. Not the best return, the best risk-adjusted return. And this is the way that the funds have been managed for the last 10 years, and nothing's changed. So the indicators I've included just for a quick reference, but Reuben, you can actually jump to the next slide as well, because the indicator basics remain very much the same. Reuben, if you'll move along. So this is really the reference for you going forward. So if you, I'm going to send you a copy of the presentation if you want to have a quick check-in on Reuben, everyone can see the presentation in presentation mode. So I don't know if there's something you can do about that. I think you may have your two screens on. Thank you, Jessica. Because now what's happening is they're looking at, thank you, that's better, yeah. Thank you. No, the way it was. That's better, thank you. Thank you. So, so the indicators, we've got a primary bear indicator and we've got a primary bull indicator. The bear indicator is the real earnings growth, and the bull indicator is the yield gap. Reuben, if you'll go into the next two slides quite quickly just to have the illustrations of that. Reuben. So that's the yield gap from a bull market indicator, and then the bear market indicator is the real earnings. So if anybody would like more clarity around these indicators, please let me know. Please don't hesitate to get in touch afterwards. we will gladly go through these indicators. We will unpack them for you. There's no Kentucky Fried secrets here. There's no secret spices. There's no secret herbs. There's a secret handshake, but I'll show you that. It's just a double tap on the heart. But please, we're very, very happy. We're very happy to share with you how these indicators work. But we don't want to get sidetracked by doing it in this presentation. So that's the reason that we've just included them as a reference. It's also just as a reference, this time last year, this is how quickly time goes by. This time last year, the Japanese Prime Minister had been assassinated. Boris Johnson had decided it was time to ride off into the sunset. And I'm just going to say that if that is your formal photograph, then there are all kinds of issues that we need to talk about. Okay, I don't know what's happened to that slide. So there was a threat of national shutdown, and load shedding was a problem. But all of those have been resolved since then. Oh no, wait. Oh no, they haven't. But that's okay. Look, we're still here, we're still shining, we're still doing our thing. So that's why I say the more things change, the more they stay the same. I'm going to hand over to Reuben now, who's going to tap into the concerns that we have from an investment perspective then, and how that feeds through to where we are now. Okay, so Reuben, over to you.
Great. Thanks, Megan. Thanks for the introduction, and good morning, everyone. Thank you very much for your time. So our concerns 12 months really ago were all around equity market valuations, earnings, the expectations that have been priced in about China and inflation. That resulted in us being defensively positioned. We were 55% in local cash, 30% in Swiss francs, and 15% in dollars. Over the course of the past 12 months, our asset allocation has evolved as follows. You'll see that we were in offshore cash, then in local cash, spent some time in bonds, and now we have a small exposure to offshore cash. That has delivered us over the past 12 months a return of 9.7%, which is 270 basis points ahead of cash. But as Megan said, on a risk-adjusted basis, at very, very low levels of volatility. So in looking at our concerns 12 months ago and how they've evolved, we've split them into three outcomes. Number one, where our outcome was not exactly as expected. Number two, where there's been a surprise outcome, in other words, something we hadn't factored in. And finally, where we had an outcome exactly as we expected it. So let's start with those outcomes which didn't evolve as we expected. When one looks at this chart, it certainly appears as if our inflation outcome was not in line with our expectation. However, we remain concerned about inflation, and what I've given you here is the sticky and flexible price inflation graphics drawn and prepared by the Federal Reserve Bank of Atlanta. I've given you data on the right-hand side as well. And that just shows you how sticky price inflation is still pretty elevated at 5.8%. What concerns us in addition is the fact that sticky price inflation was very, very well behaved for most of the past decade, and it's only recently exceeded 2%. The question is, how long will it take to get down below 2% again? The impact on that obviously is significant. This chart from 12 months ago, where we showed you that with inflation at 8%, there was severe downside risk in terms of the potential for asset prices. I'd like you to just pay attention to the earnings number that we used then and also the price earnings ratio that we used. Fast forward 12 months, inflation is now at 3% headline, and certainly it looks as if we're out of the woods with regard to asset prices. However, please note that earnings have declined. So we've come from $198 to $176 per share on the S&P. We're 12% down. And as a result of that, the PE ratio has re-rated quite substantially. So even if at 3%, we believe the correct PE for the market would be around 21, 22, we still see downside risk in terms of inflation. So notwithstanding the fact that earnings have declined against our expectation, markets have rallied, but that rally has been a function of a re-rating of underlying earnings, even although those earnings are weaker than we anticipated they would be. When it comes to surprise outcomes, in other words, outcomes that we certainly didn't factor into the equation 12 months ago, certainly the weakness in regional banks and the insolvency of Silicon Valley Bank and 2 or 3 others took us by surprise. And we don't believe that the market has fully appreciated the risk associated with this weakness. You'll see, for example, Moody's this morning downgraded further regional banks in the States. So while it appears to be over, we think there's still a few concerns to come out of the banking system. What unfortunately did happen was that as a result of that liquidity crisis, the Federal Reserve came in and pumped money into the market. You can see here their total assets of the Federal Reserve and how that picked up as that Silicon Valley Bank and regional bank crisis unfolded. The negative for this, in our view, is that it impacts market psychology. The markets believe that the Fed put is alive and well, and we could see how very risky assets like cryptocurrencies rallied after the Fed came into the market and provided liquidity. A further surprise for us was the very resilient growth that we've seen over the past few months, and certainly we've seen that the IMF has also revised up its growth since its April 2023 projection, and this has obviously caused us to look at and interrogate if there are factors that we are missing. 2 factors have come to mind. The first is that in terms of the COVID fiscal support to the US consumer, that has resulted in the consumer being stronger for a lot longer than we anticipated. And effectively, they've been able to use that fiscal support to get through the higher prices and higher interest rates. The impact's also been evident on US corporates. And quite phenomenally here, you can see that net interest payments by US corporates have actually declined, notwithstanding the fact that interest rates have gone up. And all we can assume here is that corporates have used this very low period of interest rates to refinance their short-term debt and result in lower interest payments. However, as I indicated, that refinancing is probably focused on the short-term side of their borrowing, and as a result, this will have to be refinanced at lower rates. So while both of these factors have resulted in the consumer and corporates remaining stronger for longer, we see the end game as fairly close in that regard. US unemployment has also remained stronger than we anticipated. All right, those outcomes which were expected, certainly we were on our own 12 months ago when it came to China and the fact that we believed that the rebound in China would be a lot weaker than markets were anticipating. And that was simply a function of the fact that we saw US manufacturing as being particularly weak, and we didn't believe that China would be able to be strong in the face of that weakness. That weakness has also flowed through to commodity prices. And bear in mind that when we look at the globe and we look at the global economy, commodity prices are really important in our analysis of where we are heading. So as a reminder, we don't split the world between developed economies and developed economies. We split the world between those that are commodity producers and those who are not. And certainly the commodity story, the commodity view is for us incredibly important when it comes to determining where we are and how we should be positioned. Those commodity prices, to drill down into specifics, have shown considerable weakness. We've seen rhodium coming off very strongly, coal coming off very strongly, palladium, copper holding its own. A further point that we were very correct about was US interest rates. So 12 months ago, the mantra in the market was an acronym called TINA. There is no alternative. In other words, you had to go out on the risk curve before you could get any kind of yield or any kind of return. With 10-year interest rates at current levels, we believe that no longer applies. And so there are credible alternatives to equities out there as a result of that, of those higher interest rates. Bear in mind, this to us is the price of money, and the price of money has increased significantly, and so there are alternatives to risk assets. We also believed that earnings would come under pressure, and we believe and the past 12 months reflects that they have. Earnings are about 12% down from their highs. Many people think that this is the bottom of the earnings cycle. Once again, we tend to disagree, and it's been very seldom that earnings, once they've started falling, turn around at current levels. Also of concern to us is simply the quality of earnings. So what our experience has been historically is that when earnings are hard to find, chief financial officers become more creative. And you will see here, if you look at the annual financial statements of the large cap stocks, and we've just listed 3 here for you, that increasingly CFOs are relying on accounting estimates to deliver earnings. So if one looks at Google, Meta, and Microsoft 3 years ago in financial 2020, they were writing off their data centers and computer equipment over 3 years. That means they wrote off 33% per annum. They've all changed that and are currently writing off their data centers and their computer equipment over 6 years. So that means they're only writing off 16% per annum. That increase has gone through to profit, but in our view, it's profit of a lower quality. And so we are very aware of that and concerned that much of the profit that's been reported right now is not really a function of operational growth. So our concerns right now are as follows, and we often reflect upon the statement of John Maynard Keynes, who said, when the facts change, I change my mind. And we've got to ask ourselves the question, have the facts changed? This is what we discussed with you 12 months ago. We had concerns around inflation, earnings, interest rates, and global markets. I'm not going to go through the detail, but what I will do is just highlight what our concerns remain in respect of each of those factors. The bulls have priced the market back with inflation at 2%. We believe that sticky price inflation has not been resolved, so we remain a little bit concerned there. When it comes to earnings, we believe that the pressure from the rate hikes that have been implemented are still to be felt in the market. When it comes to interest rates, we believe that they are higher, not only for a short term, but in terms of a secular change. TINA no longer applies, and the recent move by the Bank of Japan, in terms of which they were going to exercise yield curve control more liberally, and the bringing to the end of that very low period of interest rates is, in our view, very significant. The Bank of Japan, the yen, was in fact a source of very easy money for carry trades, and a lot of investments don't make sense anymore should those Japanese yields go higher. As a result of that, our concerns around global markets remain elevated, and we continue to be positioned in a risk-off environment. One of the indicators, or two of the indicators that make us very concerned at the moment and add a level of assurance to our positioning is US yield spreads. And what we've given you here is the US Treasury 10-year less than 3-month constant maturity. You'll see that every time that crosses the zero line, it has been followed by a recession over the past 40 plus years. It's currently very, very negatively positioned, and that's borne out when we look at the 10-year minus the 2-year constant maturity. So those two charts are critical to us, and they both portend the level of economic weakness in the United States. As Megan indicated a little bit earlier, our objective is to generate for you the best risk-adjusted return. And we've also learned over time that when the Federal Reserve produces a research paper which has relevance to the markets, that we don't ignore that. This is a paper produced by Michael Smolyansky, the principal economist at the Fed in mid-2023. It's called The End of an Era, the Coming Long-Run Slowdown in Corporate Profit Growth and Stock Returns. And we will send you this paper. I ask, please, that you have a look at it. But I'm just going to run through 2 slides which emphasize what it's all about. In the abstract, he says as follows. I show that the decline in interest rates and corporate tax rates over the past 3 decades accounts for the majority of the period's exceptional stock market performance. Lower interest expenses and corporate tax rates mechanically explain over 40% of the real growth in corporate profits from 1989 to 2019. In addition, the decline in risk-free rates alone accounts for all the expansion in price-to-earnings multiples. I argue, however, that the boost to profits and valuations from ever-declining interest and corporate tax rates is unlikely to continue, indicating significantly lower profit growth and stock returns into the future. So, just to give you some numbers, the S&P has grown substantially over the past 30 years. It's grown in excess of GDP, but that growth in earnings, which has been reflected in the bottom lines of companies, has not come through in the EBIT line, so earnings before interest and tax. It's really been a function of lower tax rates and lower interest rates. Please have a look at that document. We think that it's a critical bit of information. So right, where does that leave us? Right now, our current asset allocation is local cash 85, offshore cash 15. We would look to be taking that up. And as I indicated earlier, the volatility in commodity prices tells us that going forward, the world is unlikely to be a better place in terms of prospective returns. The volatility in the rand has been quite significant, and that provides us with a number of opportunities, both acquisition and sale of the currency. And we are watching very carefully at the moment the disparity which may arise between the Aussie dollar and the South African rand. Whenever the rand moves away from the Aussie dollar, we are of the view that there are matters other than fundamentals being priced in, and that gives us the opportunity to, as we say, make cash sweat and add value for our investors. So that's our asset allocation at the moment, and we would certainly look to add offshore cash should we be granted the opportunity. In summary, let's look at the fund delivery. We like to commence with this slide and simply what it says. WB stands for Warren Buffett, and he has two rules. Number one, don't lose money. Number two, don't forget rule number one. And we believe that we've managed to achieve the returns that we have by virtue of the fact that the extent of the drawdowns in the fund and the duration of the drawdowns in the fund are far less than our peers and far less than the underlying asset classes. That really is the secret sauce, if there is anything, and it certainly has assisted us in producing a good and a very low volatile return profile. This is confirmed when we look at the underlying asset classes, and we believe our returns here show the ability to move between those asset classes, cash, bonds, and equities, and deliver a return which supersedes those underlying asset classes, but then again, also at lower levels of volatility. What I have here, the purple line, is the Gryphon Prudential Fund and its return over the life of the product. What we have in red is the JSE All Share, dark blue, the All Bond total return. Black represents the average of the South African multi-asset high equity funds in South Africa, and green is the cash return at Steffi. And one can see here how we've managed to produce a very good risk-adjusted return focused on NAV preservation. I certainly think that at current levels over the past 3 years, our returns are muted relative to our peers, but sadly you had to lose money in order to generate those exceptional returns that are reflected in the market right now. What's also concerning to us is that cash has produced a very good return, and peers have not beat that by a very large margin, but they have given you substantial levels of volatility. So it's our view that our performance has been very good relative to our underlying asset classes and peers. We've also given you that performance at very low levels of volatility and with downside protection. I thank you very much for your time. If there are any questions, please go ahead.